In Chapter 15, you were dealing with investments, and the two problems I selected to review with you are Problem 1519A and Problem 1520A on page 827 of your book. So in 1519, we have Jetway Corporation. They generated excess cash and invested in securities as follows. And so there's a list of various securities they invested in. In step 1, it says classify each of the investments made during 2018. Assume the equity investments represent less than 20% of ownership of outstanding voting stock. So the investment in Pogo Inc., which happened on July 2nd, is an equity investment with no significant influence. Why? Because it is less than 20% ownership, and it states that. The Violet bond investment is classified as a trading debt security because they're going to sell it in the short term. So knowing that will help us determine how to make the journal entries for Pogo. For Jetway. So let's take a look. Now I'm going to break this into two slides. The first being the first 2 or 3 journal entries we will look at. Let's look at the July 2nd purchase. The company purchased 4,200 shares of common stock from Pogo Inc. at $12 per share. Jetway plans to sell the stock within 3 months when the company will need cash for normal operations. Jetway does not have significant influence over Pogo. So, the company will debit equity investments for the purchase price, which would be 4,200 shares that they bought times $12 per share. It has a little a there, but that's what the little a depicts. The 4,200 shares that Jetway purchased paying $12 per share. So debit the asset equity investments, credit cash, $50,400. On August 21st, the company Jetway received a cash dividend of 80 cents per share on the Pogo stock investment. So since Jetway's the one owning the other company, they will receive the dividend. So they're receiving a cash dividend of 80 cents per share of stock. So 4,200 shares are what they own times 80 cents, and that's what the B computation shows. Then they would be receiving $3,360 of cash, which they debit, and credit dividend revenue, $3,360. Now, in the next journal entry on September 16th, Jetway sells the Pogo stock for $13.40 per share. So first we need to determine how much they'll receive in cash, and that's the D, and you could see the little table underneath which depicts this computation. 4,200 shares were sold. They sold them for $13.40 per share. If you multiply that out, the total amount they sold them for was $56,280, which is debited. They'll credit the investment account for the 4,200 shares times the original $12 they purchased them at, or $50,400. So credit that asset equity investment, $50,400. They received $56,280 on the sale for something they only paid $50,400 for. So the difference will be credited to an account called gain on disposal. So just like when you sell any other asset for more than what it's carried for on the balance sheet, and that will be $58.80. Remember, gain on disposal would be reported on your income statement in the other revenue and expense area. So if you're not remembering that quite right, take a look back in Chapter 5. Take a look at the income statement. So that shows you purchasing, what happens when they receive a dividend, and ultimately what happens when they sell that stock. Let's look at October 1st. Now instead of the company buying stock, they purchase a bond. They purchased a Violet bond for $20,000 at face value, or at $20,000. Jetway classifies the investment as a trading and short-term investment, so they're only going to hold this bond for a short period of time. They'll debit trading investments $20,000, credit cash $20,000. On December 31st, when they receive an interest payment from Violet for the bond, they'll debit cash $100 and credit interest revenue or income $100. At the end of the year, the only trading investment the company holds is this Violet bond. At the end of the year, they must show any trading investments at their fair value on the balance sheet. Currently, if you do a little T account, in the trading debt investment account, there's a debit balance of $20,000. So if we did nothing, you would record this bond on the balance sheet at $20,000. However, we know we can't do that. We're supposed to report it at its fair value of $22,000. So what we need to do on December 31st is make a journal entry debiting an adjunct account. An adjunct account will either increase or decrease, depending on its balance, the trading debt investment account. We need this account to increase the trading debt investment account by $2,000. So we debited $2,000. So there's a debit in the investment account and a debit in the fair value adjustment. Those two accounts will be combined and reported on the balance sheet at $22,000. What do we credit? We credit an unrealized, meaning not realized yet. So it's not a sold gain. So this gain is not the result of a sale. That's what that indicates. It's merely a gain because of the difference between the fair value at the end of the stock, or I'm sorry, of the bond, and its carrying amount of $20,000. That unrealized holding gain of $2,000 is reported on the income statement in other revenue and expense area of the income statement, just like the gain on disposal. So that is how we do the journal entries and accounting for trading investments in equity or debt. Now in part 3, they want us to prepare the T accounts for the investment assets and show how to report the investments on Jetway's balance sheet on December 31st. So, equity investment account. I know it's kind of squirrely looking, but if you look, on July 2nd, when we bought the equity investment of Pogo, we debited the equity investment. When we sold the equity investment on September 16th, we credited the equity investment. So it has a zero balance at the end of the year. On October 1st, we debited the trading debt investments for the purchase of the Violet bond. We didn't sell it, so it still has a debit balance in it of $20,000. On December 31st, we debited the adjunct account. Remember, adjunct accounts increase other accounts. In this case, it will increase the trading debt investment, this fair value adjustment trading. So it's an adjunct asset. We debited that for $2,000. So that $2,000 debit balance in the fair value adjustment account will be added to the debit balance in the trading debt investments. And at the end of the year, on the balance sheet, under current assets, because remember, trading securities are going to be held only for a short period of time, less than a year, we will report this trading debt investment at its fair value of $22,000. In step 4, I already answered this for you, but once again, the unrealized holding gain or loss associated with the trading debt investment, that's that $2,000 from that last journal entry we did on December 31st. It's reported in other income and expense section on the income statement. Okay, so that's how you handle some transactions when you're buying debt and equity investments and they're classified as trading. Let's take a look next at 15-20A. In 15-20A, we have the beginning balance sheet of Waterfall Source Company. Included in this, and you could do a T account, is a $400,000 investment in Evans stock, 20% ownership, and Waterfall has significant influence. When you see that, that means it's being accounted for under the equity method of accounting. The equity method, not the fair value method. Equity method is a little different, as we'll see in a few minutes. So we have, right now I'm going to do my T account, and you could do a T account in front of you. Investment Evan stock, 400,000. Okay, so from there, let's keep going. And that's an equity method. These are all equity investments if you buy stock. The equity method is a way of doing journal entries when you own more than 20% of the stock of another company and significantly influence their operations because of your ownership. March 3rd. Let's see what kind of journal entries result from these transactions. Purchased 4,000 shares at $11 per share of Lilly Software common stock as a long-term equity investment, representing 7% ownership, no significant influence. So we'll debit equity investments. That doesn't mean it's equity method. We own less than 7%. We're going to use the fair value method. Debit equity investments, 44,000. Credit cash. Where does the 44,000 come from? As you can see below, 4,000 shares were purchased, $11 a share. So we set up a separate investment account called equity investments. May 15th. And remember, that's an asset account. May 15th. Received a cash dividend of 61 cents per share on the Lilly investment. So on that stock we just bought, which we own less than 20% of, we received a 61 cents per share dividend. 61 cents times the 4,000 shares, so we received a dividend of $24.40. Debit cash, $24.40. Credit dividend revenue, $24.40. Now, that's very similar to what we did in our last problem. Why? Because we own less than 20% of the stock of the other company. Watch what happens on December 15th, when the other company, who we do significantly influence, pays us a cash dividend. When we received a cash dividend of $70,000 from Evan Investment, remember, we own more than 20%, significant influence. We still debit cash for $70,000, but we do not credit dividend revenue. We actually credit equity investment Evan. So we decrease that balance of $400,000 by $70,000. Remember your T account? I told you to write $400,000 on the debit side. Well, now we're going to credit that same T account $70,000. So when you get paid a dividend and you're using the equity method because you own more than 20% of the stock and you can significantly influence the company you own, you credit the investment account when you receive a dividend. Now, what else happens? On December 31st, Evans also reports its annual financial statement information showing $300,000 of net income. Under the equity method, when you own more than 20% and significantly influence the other company, such as Evan, you must take your percentage of net income. 20% of 300,000 is 60,000. Increase the investment account. So we will debit the equity investment Evan and credit revenue from investments, $60,000. Now let's talk about why. Why are we doing this? When you are not significantly influencing the company you own, you're just a normal investor, as they are with Lilly Software. They only own 7%. When you receive income, such as dividend revenue, that's when you report that as revenue. But when you significantly influence, you are having more control over the operations and actually controlling more of when and how they make their net income. The FASB looks at this as, you shouldn't wait till you receive a dividend to record revenue. You should record revenue on this investment as the other company makes net income. So as Evan makes its net income, their share of it is reported as revenue on their books. Increase the investment, increase revenue. And then they say, well, and then when you get that money as a dividend, because what is a dividend? It's the payment of net income back to the shareholders. So when you get the dividend, don't show it as income again. That's double dipping. No. Debit cash and credit the investment. Reduce your investment where you stored that revenue as it was being made. And that's the thought process behind this method. So if we decrease investment in Evan, $70,000, and increase it for the $60,000, the current balance in the equity investment in Evan is $390,000, and it's actually that amount that will be reported on the balance sheet. No fair value with the equity method. And that's because of the amount of ownership and exercise of control. Now, if we go to the next item, it says Lily's annual report is $120,000 for the year. Well, good for Lily. That's great. But it has nothing to do with us. We only own 7% of Lily. If we owned more than 20% and exercise significant control, then we would account for that the same way we did Evan. Evan's stock fair value at year end was $390,000. Again, that's wonderful, fantastic. Our investment's going up. But back at Waterfall, we don't do anything with it because we don't report equity method at fair value. Remember, equity method is when you own more than 20% or exercise significant control. When do you use the fair value? For the last one. Lily, who we only own 7% of, reports their fair value at $12 a share. Well, when you own less than 20%, you report the investment at its fair value on the balance sheet. So this is important. So we'll take the $12 a share times the 4,000 shares. So the fair value of Lily's shares are $48,000. How much did we originally pay for them? $44,000. So again, we will debit that adjunct account, fair value adjustment, equity investments, $4,000, and credit unrealized holding gain, equity investments, $4,000. Okay, so that's a great problem to show you the difference between those two major methods. Okay, so if you have any questions, please post them to the discussion board. That ends our review of those two problems.